Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Hello, everyone, and welcome to the Millionaire Next Door podcast. So pleased you're here. I'm Robert Curtis. I'm the host of the podcast. We're joined by terrific guests on a recurring basis. And one of those is a return guest who's somewhat of a regular, Miles Clark from Nasdaq, Dorsey, Wright. So how are you, Miles? Welcome. Welcome to the show.
Yeah, doing great. Wonderful pleasure being back in today. We've got a lot of stuff to cover. We're recording. It's about the end of February. I'm not sure what your schedule looks like, Robert, or when this is coming out. We've got one really important thing to talk about first, though, and that's the U.S. hockey victory yesterday. I'm not sure. Did you catch the game at all, Robert?
I did. I caught it, and I didn't have to get up insanely early. I actually played some tennis early with avid hockey fans who everybody kept their mouth shut. In the afternoon, I got to watch it, but I wasn't so sure. We had that early lead, and then we were languishing, and then real quick in that overtime period with the 3-on-3, it just opened up, and so it was exciting. Yeah, it was great.
Oh, yeah. Well, I was sitting with a couple of my buddies, and I was like, there's no way that because I, just like you, in the second, third period, I was like, oh, we're getting shelled here. Let's put it kindly. And I was like, oh, it's going to be a quick overtime. And luckily it was a quick overtime, but in our favor. So anyways, we're rambling about hockey and no one cares about that. It's just always nice to see the boys in blue get it done.
No, it was absolutely fantastic. And let me ask you about curling. Have you had enough curling for 4 years? Or are you ready for more?
I actually need to see some more, but we were blessed with a bit of drama with the whole cheating scandal, I suppose. So, but anyways, great Olympics, obviously. And when you talk about, look at this transition here. International, right? International, the stage, right, of international stocks and equities doing quite well. Domestically, we're doing well in the Olympics. Markets are a little bit mixed, relatively mixed so far as we move into the third month of the year. But there's a lot of stuff to talk about. You and I were going through an agenda earlier: sector rotation, AI, precious metals, the whole 9 yards. We could really make a whole podcast about any one of those topics. I'm super excited for today.
Yeah, I'm excited too. I'm trying to recall the last time we spoke, maybe 6 months ago, but a lot of trends were in place. It didn't feel like there's always stuff to talk about, but it feels like so much has happened between rotation and sectors and AI and international. What do you feel is a good place to launch from? International having a comeback. What is it, like the first time in maybe 19, almost 20 years, and emerging? What does that say about things? But I'd love to hear your thoughts.
Yeah, it wasn't I think last time we spoke, it was a put up or shut up time, I might have said, for international equities where they had been doing so well. But we've seen fits and spurs of international equities doing quite well. But really, over the course of the last few decades, it's petered out around the 6 to 8 month time frame. We're now past that point. And actually, I just wrote a piece in the report today that talks about some of the relative strength shifts that we've seen in favor of international equities, specifically on the emerging front. We've seen emerging markets take a lead in the near and longer term for the first time in something like 16, 17 years. Last time, of course, was right before the dot-com bubble and the lost decade. So I'm certainly not trying to make any calls here. Your overall international equity landscape has been strong and really will continue to be as long as the dollar continues to decline.
Yeah, it's so interesting. And of course, the pullback in the Mag 7, that's all it was over and over again. With what I heard the other day, something that Microsoft has pulled back. It's now cheaper than Coke on a fundamental basis, if you can believe that. So there's really been some air coming out and rotating elsewhere. And curious if you have thoughts around that. It's just, there's a broadening, but it's really been swift and noticeable.
Certainly. And before we do, I would realize that I haven't talked about what Dorsey Wright is, right?
Yeah.
What we are is a technical research-based shop. So we are trend followers. We are a little bit more niche, right? But it's in the realm of winners continue to win, right? It's a little bit more nuanced to that, but we specialize in point and figure charting, which again utilizes price to really tell us where there's relative strength and where there isn't. So again, we're following the trends, we're following what's winning and avoiding what's losing as best as we can. And what has been losing on a relative basis in 2026 so far has been technology. You've seen technology fall out of grace, moving out of the top position within our sector rankings over on our Dolly rankings, which is one of our kind of broad asset level tools that we'll look at. But it's fallen out of the first position and into the fifth position. So it's still scoring relatively well. There's points of strength in there that we can pinpoint, which maybe we can talk about a little bit later. But there is a now widening of sectors that are doing better than technology, which I would actually say is quite good for momentum. I'll pause just for a moment because I could ramble on it being good for momentum and a little bit more. But yeah, we've seen technology weaken, the Mag 7 weaken. They've lost technical favor in terms of the kind of TA scores that we look at. The likes of Google, Google and Apple are the only two that are technically acceptable by our standards now, as software has really led things lower. And yeah, you're seeing supply take over for the big names, but not necessarily elsewhere, if that makes sense.
Yeah, it does make sense. We're seeing other sectors move into energy, right? Hasn't been there for a long time. And then I'm just curious as your thoughts when you look broadly speaking, the markets are not far off from all-time highs. And I didn't know if you saw any big alarms going off or areas of concern. I know investor sentiment, they just had a recent set. You had some thoughts on that. Maybe if you'd like to chime in.
Yeah, sure. In general, right, people are getting a little bit bearish. This always happens when markets pull back 5 to 10%, right? Because in order to be down 30%, you have to be down 5%. In order to be down 30%, you have to be down 10%. So every single time there's going to be headlines that emerge when you're down 5 to 10% off of your highs, that this is ultimately the one. I want to go back to one thing before the sentiment conversation, though, which was how well we're seeing other sectors do in comparison to technology. To quantify this, we used the 11 sectors, right? So technology, industrials, energy, so on and so forth. And it was a very simple study that just looked at the number of sectors that were outperforming the S&P 500 on a calendar year basis, right? So we went all the way back to 2006 and then just did a rolling count. In the last few years, 2023, 2024, and 2025, we saw only three sectors in each one of those years outperform the market. And two of them are extremely tech focused, right? Comm services and technology doing very well in each one of those years. Now, so obviously it's been a very narrow market environment is what I'm trying to say. When you zoom out to the last couple of decades, that average is five. Five sectors are typically outperforming the market. And when you look at what we're doing so far in 2026, again, this is through the 23rd of February, we have six sectors that are actually doing better than the market: healthcare, real estate, utilities, staples, industrials, basic materials, and energy. You'll notice no tech focused areas are in that group. So it's not necessarily that the entire market is doing really bad. Actually, the average S&P 500 stock is higher so far this year. It's just been where that weakness has come from, and that's why the overall strength from those sectors is good for momentum because we can focus there. Does that make sense?
Yeah, it makes a lot of sense. And it's just so interesting. I leading up to this, it just seemed like there was continual risk taking. The precious metals have been going crazy. I always thought there was a big case for that, what their physical use in things like your iPhone and nuclear power, et cetera. But just all this excessive risk taking, even on the crypto space, and people they just wanted to lean into risk, and there was no interest in more conservative, sort of just solid areas of the economy, or a lot less until it all shifted. And then the other big factor is just the AI. And I had been noticing and commenting, including on this podcast for a good year and a half, how now these big tech companies, hyperscalers and whatnot, they were spending close to 100% of their earnings on investments in infrastructure. And these were previously really kind of asset light type companies with massive cash flows. Now it's all going into that. And we're still in the early stages of building out the infrastructure to that's really caused some dislocations. And then the concern these software companies are going to not exist because AI is just going to take over. I heard a very interesting discussion from some people really dealing with private markets, but in their software space. And a lot of these things are so complex, the relationships with the software. You can't really just bring in a piece of AI and replace all this software that's been around for a long time. It's a really interesting environment. That's a mouthful there, but I don't know if you have any thoughts or observations or anything came to mind with those kind of thoughts.
Yeah, it certainly does. I remember we were just past up earnings season and we were sitting in the office and a couple of the other team members, the other analysts and I were looking at Google's results and you're looking at their CapEx, right? And it is the equivalent of the GDP of a small country in a single quarter. And these companies are spending massive amounts of money on it. Obviously, the race is if we can be first to market on the completely generative AI, that's a massive, and it was all worth it, right? But the point is that there does need to at some point, investors are going to say, where's the return on all this capital? I do want to admit that is outside of the scope of my knowledge. We're technical, so we just
Yeah.
follow the price. But you don't have to be a fundamental analyst to actually start to question where ChatGPT is making its money, right? I don't see ads, or maybe there are some ads on lower tier, or I digress, right? The point is that there is a lot of investment in this, and expectations are lofty, right? You can't just say on an earnings call that you're investing in AI and suddenly your price is up 20%, right? You actually now have to show some tangible results associated with that. And as long as the bar is a little bit higher for those companies, I imagine that's at least a somewhat significant headwind for these technology companies who, again, to use the language, is in put up or shut up mode for their AI investments that are obviously extremely costly. From a technical perspective, we have seen those expectations, those expectations come through in some of the price, right? As I mentioned before, the likes of your kind of big Mag 7, the guys that are extremely involved in AI, they're sitting well off of highs, right? Meta now off around 3 or 4% so far this year, still relatively attractive. Amazon, very similar, right? Now, they're not completely AI focused, but you get the gist. These big companies that have a lot on the line are starting to roll over a little bit, while some of the other areas, utilities, right, the kind of pickaxes for these companies to build this infrastructure are still doing quite well because the race is underway, right?
Yeah, no, 100%. And interestingly, I think we had commented for a long time of this massive over concentration, right? In the Mag 7, maybe 45% of the major indices, or you commented earlier about being more than the market cap of a country, et cetera. You know, that they were gigantic. I think they were more than maybe Europe, for example. Don't quote me exactly on that. What comes to mind is when dollars flow out of those spaces, because there is so much, it doesn't take very much if it flows into other areas, international, because there's so much larger or energy or other spaces to really move those in a meaningful way. So you're just seeing massive amounts flow out, and perhaps too much had flown in. And we had been making the case for a long time about the other 493 stocks in the S&P 500. And also some of these could be massive beneficiaries of AI, right? Other types of companies without having to front the costs or fund the whole infrastructure. They'll get benefits over time as it picks up adoption and efficiencies. It's really interesting to see all that. Yeah.
And I'll throw it out there too. As I mentioned before, other areas besides technology doing well, it can be a major tailwind for us trend followers who are able to avoid technology while
Uh-huh.
major benchmarks, they can't. The technology is what, 30% of the S&P 500. Just in most recent terms, when the markets were down in 2022, the back half of 2022, the S&P 500 was roughly flat, while momentum proxies were up 9%. And the reason for that is that you're able to take away allocation from technology, which other money managers or other just major domestic indices for that matter cannot avoid, right? Because they've got a benchmark. But momentum is self-correcting, right? It will essentially say, I don't like technology right now. Everyone else is forced to buy it. We don't. And so we can go overweight other areas of the market. Now, sometimes that works, sometimes it doesn't, right? It's not a silver bullet. But my point is that for us who are trying to deviate from the benchmark or beat the benchmark, things doing better than the benchmark is a good thing, because that means that we can go pick them, and we're not just stuck buying the S&P 500 over and over again. Another thing you mentioned that I think is very interesting that kind of furthers that conversation is Dorsey Wright's participation indicators, which we've talked about on previous podcasts. But when we look at something like BP NYSE, which measures the percentage of stocks listed on the New York Stock Exchange that are trading on buy signals. So there's some jargon in there, but know that buy signals are good, right? When we would see that reading, on average, it's towards the middle of the pack. And you would expect, if markets were struggling, you would expect to see that value falling. But what we've seen actually is that value sit at its highest level in 2026. So we're around 62% of that NYSE listed universe trading on buy signals. That's around the highest level that we've seen since 2021. And so point being is that some of your major tech stocks are doing poorly, but your small caps are doing relatively well. The other sectors that we've mentioned earlier are still doing quite well. And so you're seeing participation remain relatively elevated while major benchmarks are roughly flat. Does that make sense?
It does make sense. Yeah, absolutely. And momentum has been an important factor I've emphasized in a lot of portfolios with clients. And it doesn't always work, but more often than not, it does, or it makes these adjustments. We've used MTUM, PDP, Focus 5. So it is just interesting what moves in and out of those models, right? Like seeing where energy went in a few years ago, but now it's starting to come back in, or you're seeing some move away from some technology. Any thoughts around that? And I let folks know that the other indices have become so large, and even if I'm not mistaken, the Fama in French, the guys who did all the indexing, said very few things can beat these indices other than actually a momentum or relative strength is what. So it's a good, I think people like knowing that strategies in there. Things like FDN, internet, we'd seen just stay in there for like over a decade. And that strength just continued. And for the most part, anybody could see they wanted to be a part of that trend. And other trends that were going the other way, as I call it on I-5 or I-90 South, you want to avoid until maybe that changes. But some
Yeah.
thoughts, yeah.
Oh, yeah. There's 2 points there, and it actually parlays quite nicely into the sentiment conversation from earlier. Momentum is a self-correcting strategy, right? So it is not afraid to admit when it's wrong, and it also will continue to buy things for much longer than you would probably think that you should be. And so a really good example of that before we get into the sentiment stuff is on the precious metals front. Momentum was continuing to buy silver. It was continuing to buy silver, and clients were calling in and saying, we can't possibly buy silver here, right? The thing is up 100% this year, nearly 100% last year. I would have told you now silver is off the highs, that, yeah, we were due for a pullback. Silver was historically overbought, but I also would have told you silver was historically overbought at 70 and 80 and 90 and 100 and 110. Meanwhile, I would have been uncomfortable following my emotions, buying precious metals there. Momentum is going to say, this is a tail event. We're going to ride it until we can't. And so now we've seen it pull back a little bit, right? The pullback did come for silver. But point being is that all the while, more value focused areas are saying, this isn't possible. We don't like it. Meanwhile, momentum was just riding that wave until essentially we couldn't anymore. So that takes place in the models, that takes place with individual names as well. Point being, it's gonna ride your winners, it's gonna ride your tail events, which is great. The sentiment thing, which is very important too, and goes into that, is human nature is to follow your gut. But more often than not, right when you are scared, you should actually be putting more money to work. And right when you're bullish, right, maybe it's a bad thing, maybe it's a good thing, right? But not that bad. And so to quantify that, we had put together a report piece that talked about sentiment, which just most recently turned negative via the sentiment reading that they'll put out on a weekly basis. There are now, again, as of the end of February, more bears than there are bulls, which again, you might think is a bad thing, but historically speaking, when sentiment is negative, the market is positive by about 12.5% the year later. When sentiment is positive, the market is up 9% a year later. Did I say that right? When sentiment is negative, we're up 12 and a half. When sentiment is positive, we're up 8.5 or 9. So point is that both of them are good. You'll take 9 and you'll take 12. But when things are bad, you probably shouldn't be following your gut, I think is the point that I'm trying to make.
No, those are good points. And what I love about what you guys do, and I follow it quite closely, it's one of the elements I utilize, but just having a process for evaluating. I explain to clients, I call it our process. It's objective, it's unemotional, it's rules based. So we're watching tons of models, what's moving in, what's moving out, what's overbought, what's oversold. You could see it with something like silver, just extreme overbought and huge relative risk. Yet we'll see calls come in and there's a FOMO factor. Why are we underperforming this? So I think it's about a steady process. Just another comment you made, I always think of the Buffett. I think Buffett had a famous line, something about be nervous when other people are greedy and or fearful, and fearful when other people are greedy.
Right.
Be more conservative. So a lot of times people don't want to behave in those fashions, but we watch it day in and day out. We see the numbers, we see what's working. It just helps us populate with things that are in favor, and that presumably factors in all the known information about it to the extent that it can be. So it's helpful to have that process and have someone watching it and just follow it, I will say, without exception. Because if you don't follow it, you just follow, then it's akin to not having a process at all. That's why we like to say people pay us for that and to follow that process, to educate them. But a lot of times we don't hear questions coming in on that are all following that rationale. They're usually following some posts, some media, some headline.
And the problem is with that is that all the headlines are always bad, right? Because you're not clicking on good headlines. Let's put it that way, or at least I'm not as much. So whatever you're clicking on headlines and you're following emotions that headlines are driving, you think things are bad. So it's an important, extremely important process to have something that says, okay, this is objective. The market has told me that I'm right or that I'm wrong. It's not Miles, right? It's not Robert. It's just the process, the objective process. And then we can sell and move on, right? Go pick
Yep.
up exposure to other areas like internationals, like commodities, like utilities on the domestic front. And being able to admit when you're wrong, it's the hardest thing to do. I hate doing it. My fiance would tell me.
Really
Investing,
hard to do. Yeah, it's really important to do when you are. But yeah, people are reluctant to do that. Maybe even selling a loser. A lot of people want to hang on forever thinking it'll correct, but usually that's not going to happen.
the saying is, what, you liked it at 100, you're going to love it at 60, right? But
Yeah.
chances are it's probably going to 50. But that's the way the cookie crumbles on some of this stuff. The maybe main takeaway that I would have is I wouldn't necessarily be concerned. I know some of the stuff that I mentioned today about technology rolling over or
Mhm.
AI. Obviously, AI is going to have ramifications across the investing world. So I certainly don't want to make it seem like domestic equities are rolling over. In fact, domestic equities still ranks quite strong. A lot of our indicators are still a heavily risk on. We are seeing some signs of some more value areas just leading the way. but domestic equities are still strong. And as we say, it's about time in the market, not necessarily timing the market. Now, we want to be smart about when we're getting defensive and what types of names we have in our portfolio. But more often than not, we want to just be adding money to our process over and over again, right? Sometimes ad nauseum, but to get there at the end and kind of fulfill that process.
Yeah, no, that makes a ton of sense. We're just seeing a lot of things happen, a lot of models move around, a lot of rotation. So it is a really interesting time to pay attention what's going on and having a process to employ that. And then when you talk about the media and all these factors or social media driving fear and greed, I I think it's always important to have a process, but it feels to me like that machine has just gone into overdrive and is working harder and harder. So to have that systematic, objective, unemotional, rules based process, one that's vetted, to be in touch with other colleagues and when you're allocating these funds and trying to protect. I think you'll hear these calls come in or folks are I'm underperforming the S&P 500 and then they're really conservative people that should never even be compared to they don't understand, they forget that. It's easy for them to forget that. We like to protect as well. Any other good thoughts you have or just it's things that are really standing out? Otherwise, I super appreciate this check-in and it's an interesting time. It always is. So it's great to have you as a regular colleague on this podcast.
Yeah, of course. One thing that stuck out to me, and then I've got one other comment.
Yeah.
But one thing that stuck out to me is the importance of finding the proper benchmark. I talk to advisors all day, every day, and everyone compares themselves to the S&P 500, especially when markets are doing quite well. Everyone wants to beat the S&P 500 because most of the time markets go up. But it's very important to understand wherever you sit within your investing career, you're taking on different risks, right? And your actual risk tolerance is changing, maybe without you even knowing it, because you're ultimately trying to plan. So just keep that in mind when you're comparing yourself to a benchmark. It's very easy to look at the nightly news and see the S&P was up 15% this year, but ultimately there was another world where the S&P was down 25%, and
Yeah.
you wouldn't have been in that because you're in a less risky portfolio. Just keep that in mind. Benchmark selection is very important. And then the other thing that I'll mention, and I ask you this question every single time, is because I'm very curious, how are the Bitcoin calls coming in? Are people calling or talking about crypto and Bitcoin to you? They have been coming in more to the office now. So
Mm.
I'm curious if you've gotten any more.
Not a huge uptick. I got some calls on precious metals and stuff like that, but not a lot on the Bitcoin. I do get them periodically, and I just explain my perspective on it, where it is. I know people have allocations there. I don't get it. I'm just going on record saying I have zero exposure. I don't feel any FOMO out of it. That doesn't mean other people shouldn't, but I haven't. I just tell them how I feel. I can't pay my taxes. I can't pay various vendors. There's really nobody I owe money to that'll accept Bitcoin.
It's
It
probably a good thing.
complicates your tax return. I think it last several years, the CPA, about the second or third question they had, do you have any cryptocurrency? If you check that box, you're opening yourself up to a lot more scrutiny on the return. So I don't feel a compulsion. I know other people do, and we try and explain what might be a suitable way to go in or where they could go into it. But I haven't seen a big uptick in that. And then it's had a pretty massive correction.
Yeah.
Yeah.
There's something, and funny is not not is not the right word. Maybe ironic about the people who are saying that Bitcoin is replacing gold, and they've got all their money in Bitcoin rather than gold, and then
Yeah.
suddenly gold is up
Yep.
50% or whatever it ends up being. It's always interesting, and people who are calling in about it, they're saying, "Is it time to double down?" and everything like that. I'm not giving recommendations on it because chances are it's going to move around a trillion times before this gets released. But I'm always just curious just to gauge the sentiment of it and people if people are calling in. Otherwise, I really appreciate you having me on. I think this is the maybe fourth or fifth time, and it's always great talking about what markets are doing. I absolutely love this. If there's any other questions or anything like that, I'm always happy to do this going forward and next quarter, next week for all that matters if you want to talk about what's changed.
It's great, Miles. We really appreciate you having you. You're a great resource. And then I love your closing question on crypto. So if anybody does call in, you can ask. We can give you numbers through your system. Here's the relative risk. Here's the overbought. At least run through the process of where we stand to make this, to let you know where it stands. So it's a really great process. Engaging with you it's great. I think you might be our most frequent guest. There's another guest who is really interested in getting there, and he calls it the green jacket. So we're trying to maybe produce a jacket fictitiously. That's a pretty cool one you're wearing at the moment.
I am wearing green. Y'all can't see that, but
that's good. So anyway, hey, I thank you everyone for listening. Thank you, Miles, for being here. Please feel free to reach out if you have questions. Please share this, like it, stay engaged, and we'll continue following the process and watching everything and where things are rotating, because it does matter and it's awfully interesting. It's a very dynamic economy with a lot of factors going on. And this helps shed some light and some clues on that. So really appreciate it, Miles. Thanks so much.
for sure.
Yeah. Have a great day, everyone. Take care.
See ya.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.